Good morning, everyone. We got a nice one today for you. We're going to be talking about how you should be investing in a very volatile market. And let's be clear, as any of us know in this market right now, it's nothing but volatility. Every single day, you don't know what to expect necessarily. Sometimes you'll get a minor movement on the market. Sometimes you'll be getting major up or down. It's kind of wild. It's a wild time to be in the market. I haven't shown the portfolio in a while. Obviously, we're approaching on 30,000, so it's really exciting stuff to see there. Important to note, if you want me to go more in depth into this, into my portfolio, I will for sure. But this is just as a reference here, as a standpoint of where you can see some volatility, and I can go into it. Just leave a comment if you want to see more of this portfolio. I'll show you what's going on with it. Obviously, the past year's been incredible for me. I can't lie to you. We're talking about an 83, nearly 84% gain in the last year. Quite intensive, but you do see the volatility spikes here. I'm sure you can. We have a lot of downward movement. We have a lot of upward movement. But there's volatility everywhere. You see this March drop when you include all time. You see the huge drop at the end of February here that wasn't included in that, and that's what I'm talking about in terms of volatility over the last 3 years. Portfolio's been in place since July of 2017, and you just see the volatility that has been present in even the last 3 years alone. The last year's been obviously a little bit more wild, but again, it's a volatile time. We look at the S&P 500, and you look even year to date. Look at these giant upward and downward spikes day by day here. It's kind of crazy. You look over the last year with this, similar story to what you saw with mine. Overall, more up than down, but still, in the long haul here, up 58% over the last year. Pretty intensive. But if you look 5 years out, it's volatility everywhere. Huge dips here in 2018 to end the year negative because of that. Obviously, this February we saw that, or 2020 February we saw that. 2018 again, dips everywhere. So the market it's incredibly volatile, but there are many things that I want to point out here in today's video. One, my main thesis here is that it is much better to have your money in the market, regardless of volatility or not. You're better off having your money in the market rather than sitting in the bank. So I will make an argument for 3 different investing styles today, what the pros and cons are, and where you can see that in. So I'll be giving examples of each. Let's just look, obviously, for reference. I just want to say why it's better to be in the market than not. So you see historically the S&P 500 returns here. You see a lot more green than you do red. There's no doubt you see years in which we do see a lot of red, no doubt. A string of 3 years is pretty rare to find. Typically, you'll see 1 year of red and 2 to 3 years in the green. That's just what you see historically, just frankly how it goes. So as we look through, if you didn't like looking at the chart, you see, look at all the green on your right-hand side and annual change. Well, there we go. I thought it would let me drag. Look at this, red, or green. So much more green than red, because historically, if you put your money in a nice, just basic fund tracking the S&P 500, you'll likely get 7 to 10% a year in annualized return. Nothing crazy about that. It doesn't take much, okay? It doesn't take much at all. So here I'm going to lay out the 3 different investing styles and stocks that match that portfolio there, that consistency. So here we're going to be talking about these 3 styles. First, obviously passive. I've got a risk, our return levels, and pros and cons for each. On the passive one, you're talking about a lower potential return here for sure. The entire point of passive investing is here listed in the pros. It's a set it and forget it mentality. You want to be able to just put your money in and just let it grow there, and you don't have to worry about too much in terms of managing it. So this is where you want to get into a fund or something consistent, something like Apple. Very consistent with very high growth potential, actually, but this is one that's kind of a no-brainer investment that you know will be consistent. if you look over the last 5 years, this is one that, frankly, just a consistent green time here. It's consistently going up, regardless of what the market's doing. Even, in the dip through February here, where it saw a decline of around 30%, the entire market fell around 40%. So even there, it's a little bit more consistency because this is a safe money bet. This is where people put their money in the market. That stocks like Walmart, you want to talk about the consistent long-term businesses that have been doing it forever. That is how you do good passive investing because you don't necessarily need to worry about it. So absolutely enjoyable stuff here. Other pros include, again, the stability there. You don't want to have to worry too hard about it. You want to be able to set your money, and you don't want to have to worry about losing all of it, for sure. That's where the stability comes into play. I can speak to this personally, and anyone who's been investing for a while can. That first year when you start investing, look, you're not into this passive lifestyle. You don't want stability. I was checking my portfolio probably 10 times a day. And thankfully, I grew out of that phase because there was a lot of money lost. There was a lot of just instability. What's wrong with me? There's a lot of instability with that method that I was doing there. And I've learned through history that, frankly, it's just much smarter to not invest only in some too wild of companies. No one's got time for that. But if you do, you do. And another consistent pro here is going to be dividends. So typically with these passive companies that I would look for, the ones you can just sit your money in and forget about it, they pay a dividend yield. So we're talking Walmart, Apple. These are stocks that consistently pay a dividend, and they typically always increase the dividend as well. So it's a consistent cash income generator regardless of the stability or regardless of the total market gains here. Capital gains, obviously, they're a big pro, but if you don't want to sit and worry about selling, buying stock too much, the dividends here are consistent because that's cash you're taking home regardless if the stock price goes up or down. So that's where that's a big pro for you. The con, obviously, being that you have the chance for a lower return here, no doubt. You can definitely make more money doing other strategies. I will line out the far right one first now, which is going to be the highly aggressive. So I think a lot of us have experienced the highly aggressive this year alone because we've seen some of the most drastic movement in particular stocks this year that many people have. And I think you know which one I'm talking about, but we'll get into that. The return here, it's all over the place. You could have very high return. You could have low return, close to zero, or frankly, you could have negative return. That's the issue with aggressive investing. You're going to be in and out of the market pretty quick. You're picking up stocks very quickly on a whim, and you're looking to sell them a lot more quickly than you would in terms of a long-term hold. So this includes stuff like options trading as well. So that's where you get that aggressive mentality in there. So the main pro here is going to be in potential. The potential for high return with this aggressive strategy is intense. I've got plenty of examples of that as we look through my portfolio here. I'll just really brief you on this one. It's NEO. I think you know this. I was very aggressive on NEO. I bought 200 shares previously. Ended up with a massive return. Still hold 25 of those shares for a 2,000% gain. So if you know me, I've definitely been part of this aggressive strategy. I've done it before. And I've reaped the benefits. I've reaped the benefits of high return. But again, as I talked about in my first year of investing, I've definitely reaped the downside of this as well, where if you're not putting in the time, there's a good chance you're not going to get a good return, and you might end up losing money. So that's what you need to consider there. And again, that's with cons. This is an intensive strategy. You have to spend a lot of time on it. Not only time looking at the portfolio, but research is essential when you're talking about this. So people like Ray Dalio, you may know from his short on the big banks in 2008. He didn't just go on a whim and think that the big banks were going to fail. He didn't think that. He did a lot of research, hours and hours and hours, weeks of research to determine that he believed he should buy, he should short the banks. We're talking about put options on these banks. These are going to fail. He took the time. And if you don't take the time, you're likely going to get a rough return. You can get lucky, but not. And again, other con being highly risky. Prime example here, I don't think anyone would disagree with this. It's going to be GameStop. We're all witnessing somewhat of a wild story going on. Let's just look year to date on this thing and tell me if you see anything that's a little bit weird of this. This stock started the year at $17 a share. Then, within a period of a week, it shot up 700%, $300 per share. It shot up within a week. Then, within a day, fell 44%. Then shot back up another 67%. Then next day shot down 20 or 72%, and within 3 days was down 83 total percentage points. That is where I'm talking about a hyper-aggressive style here. Here is where the issues come with this. So, hyper-aggressive, it can mess you up. I know there's a lot of people here that had the fear of missing out, FOMO, as you might hear in the market, because this stock was skyrocketing. So when it was going upwards of $200, $300, people were putting in their money then because they were afraid they were going to miss out on even further return. And then when they found out the next day, it shot down 40%. I can guarantee you there's a lot of people that sold out at a loss of 40 to 50%. Very quickly, within a day. That is the issue with this aggressive investing style. That it can happen. You may have been the one that gets the massive return, but you may be the one that gets the massive negative return, talking about 50% depreciation in your assets that you put in. So that's where aggressive can be negative for you. But again, some people win, some people lose with aggressive. So it's entirely up to you on what you're feeling there. My middle one here, the strategy that I am most confident with, here's a moderate style. It's honestly a good blend of both. So I'm not too passive. I'm pretty passive, and I'm a huge fan of dividends. If you might know, which I guess I haven't said anything about it, but for the entire last year, I earned nearly $700 worth of dividends in my Robinhood portfolio, which is nice. That's just passive income I made. But here with this moderate strategy, as I scribble more, with my beautiful handwriting, the return here, frankly, you're kind of in charge of your own destiny, but for the most part, it's an average return. So average, we're talking about a consistent 10% every year with the potential for higher return. It's one of my pros here. Potential. You see that? Potential is a return. It's a possibility that with the right time spent, the potential's here. You can earn a lot more than what you can with passive. But the good thing about this moderate strategy, you still have the stability that you might have otherwise. So stability, still another key factor here. You're not quite as stable as just a completely passive strategy, but you have a base to your portfolio, which is nice and stable. So typically with a moderate portfolio, what I'm running, we're only about 5 to 10% of the capital is going to be put towards riskier plays. So 90% of that portfolio I'm confident in because they are more passive and or towards the average level of risk. Now 5 to 10% of that is going to be towards the more risky plays. So that's where that 90% stability there, it's pretty consistent, but a little bit, higher return than potential than the passive. And again, with that comes dividends because as I mentioned, my portfolio yields over 3%. Right now yielding 3.5%. I'm pretty positive it's right around that range right now. So I get dividend yield, quite a nice dividend yield, as well as the potential for higher return. Now the con here, I put that it's an active investing style. So with that other 10% of your, riskier cash, you need to be more active. With the moderate style, you do a lot more buying and selling than you would with a passive style. Passive, you don't do much selling at all. But in the moderate style, you need to be able to be active and sell stock when you need to. You have to know when to move out of positions and move on to better value plays. So that's the point of moderate style. That's the strategy I go with. And it's hard to find really examples of this because there's consistency. But I just wanted to throw an example out there with this active investing style because I'm not looking at broad market. I'm not necessarily looking, I should say, at particular stocks is what I should say, but more of as a broad market. With this active investing style, that 5 to 10% of your capital you're investing in the riskier plays, your speculative plays, you can make more money. I throw out Tesla stock here for a reason. For me, it was NEO, but we already talked about NEO, so we'll look at this. Over the last month, let's be honest, I saw an opportunity, which is why I bought more NEO. But if you're doing this style, you have more time, frankly, to look at specific trends rather than having to worry about buying and selling, so much at a time. You look at specific trends. I saw with the entire electric vehicle segment, not just Tesla, every single electric vehicle company, we saw over a span of a month, stocks declined 30%. And I just realized this is an emerging market. Let's just be clear. It's an emerging market. There's no way that we're going to see declines quite yet, right? We're not in a total stock market meltdown by any means. And what a shocker, within a span of a few days, the stocks have now recovered 20% plus in terms of what they lost. So I saw in which the EV market saw declines massively within a week's period to a month's period. And I saw there was opportunity for success in the future. Now, it was a lot more short-term than I expected, but that's the main point of this moderate strategy. You have the capital you can spend towards that. So that's why I say it's better than a passive strategy entirely. And it's what I run my portfolio off of. Whoa, 30,000, baby! Whoa! We hit 30,000, baby, and it's in the video. It's in the video. Of course we did earlier, but here's the deal. This is the first time I've seen 30,000 because I didn't look this morning. It's the first time I've seen 30,000 in this portfolio. It's an honor. Ladies and gentlemen, it's an honor, okay? Where were you? Where were you when we hit 30,000? Where were you? I was here. I was here in this video. That's what I have for you today, though. So anything you have question-wise, let me know. I hope you enjoyed this and you have a great day.